So you want to own America. Not metaphorically. Not in some abstract, own a piece of the market sense. We mean it literally. For the next few minutes, imagine you are handed the keys. Not to a company. Not to a building. To the entire operating apparatus of the United States federal government. Every road, every soldier's paycheck, every Social Security check, every dollar owed to bondholders in Tokyo and Beijing and right here at home. You own the receipts and the responsibilities. You are, for this exercise, the sole proprietor of the largest enterprise ever assembled by human beings. It sounds absurd to call a country a business, but strip away the flags and the anthems and the mythology, and what you're left with is something a business economics channel can actually analyze. A cash flow, revenue coming in, expenses going out, debt compounding in the background, assets that look impressive on paper but can't easily be sold, liabilities that are legally and politically almost impossible to cut. If you ran a company with this balance sheet, your board would have fired you decades ago. But nobody gets fired here, because the shareholders, the taxpayers, didn't really get a vote on the terms, and the bondholders keep buying the debt anyway. That tension right there is the whole story. Let's start with the dream, because every ownership fantasy starts with a dream. You picture the ribbon cuttings, the state visits, the command over the largest economy on Earth, worth close to $30 trillion in annual output. You picture influence, the ability to move markets with a sentence, to project military force to nearly any coastline on the planet, to print the currency that half the world uses to settle its own trade. Whoever owns America owns the reserve currency, the world's most powerful military, the most valuable stock exchanges, and a tax base of hundreds of millions of working people. On the surface, it looks like the ultimate cash-generating machine. Revenue rolls in every April. Revenue rolls in every paycheck, withheld before workers even see it. It feels less like running a business and more like owning the house in a casino that never closes. Now look at the incoming cash more closely, because this is where the dream starts to lose its shine. The federal government pulls in a little over $4.5 trillion a year, most of it from individual income taxes. A large second chunk from payroll taxes earmarked specifically for Social Security and Medicare, a smaller slice from corporate taxes, and the rest from excise taxes, tariffs, and miscellaneous fees. That number sounds enormous until you set it next to what actually goes out the door. The government doesn't spend $4.5 trillion. It spends closer to $6.5 trillion. Every single year, the operation runs at a loss of roughly $1.5 to $2 trillion, and that gap has to be filled with something. In a normal business, a gap like that means new investors, a credit line, or bankruptcy. In this business, the gap is filled by issuing new debt, selling IOUs to investors, foreign governments, pension funds, and increasingly to the government's own trust funds. You are, in effect, running an enterprise that spends about 40 cents more than it earns for every dollar collected, and has been doing so for most of the last 2 decades. This is where the hidden liability starts to reveal itself, because a shortfall of that size doesn't just sit there quietly, it compounds. The national debt now sits above $36 trillion, more than the entire annual economic output of the country that owes it. Every year, before you spend a single dollar on schools, roads, research, or the military, you first have to pay interest on what's already owed. That interest bill has quietly become one of the largest line items in the entire budget, over $1 trillion a year now, more than the government spends on national defense, more than it spends on Medicaid. Interest payments used to be a background expense, the kind of thing that barely showed up in the conversation. Now they're competing with the Pentagon for budget space. And the worst part of interest expense on any balance sheet, corporate or national, is that it buys you nothing. It doesn't build a bridge. It doesn't train a soldier. It doesn't research a vaccine. It is pure, dead cost, existing only because past spending exceeded past revenue, and the bill has finally come due. So now picture yourself as the owner, staring at this ledger. Revenue, 4.5 trillion. Fixed, near untouchable obligations already eating most of it before you've made a single policy decision. Because here's the part that would stop any private equity buyer cold. The vast majority of this business's expenses are not optional. They're not levers you can casually pull. Social Security and Medicare and Medicaid, the entitlement programs, consume roughly half of all federal spending, and they are, by law, obligated to nearly everyone who qualifies. You don't get to renegotiate a Social Security check the way a company renegotiates a vendor contract. Tens of millions of retirees have paid into that system their entire working lives with the explicit promise that the checks would keep coming. Cutting it isn't a boardroom decision. It's a political third rail, capable of ending careers and reshaping elections. Add defense spending, another massive and largely protected category, justified by geopolitical necessity rather than fiscal convenience. Add interest on the debt, which isn't negotiable at all. Bondholders don't accept excuses. Stack those three categories together, and you've already committed the overwhelming majority of your revenue before you've funded a single highway, national park, embassy, or scientific grant. What's left over? The part of the budget most people picture when they think of government spending is a relatively thin slice sitting on top of a mountain of fixed obligations. This is the part every new owner underestimates. They assume that running the government means having discretion over trillions of dollars of flexible spending, the way a CEO has discretion over a marketing budget or a hiring plan. In reality, the discretionary portion, the part actually up for debate every year, is a fraction of the total. Most of the machine runs on autopilot, driven by formulas written into law decades ago, formulas tied to birth rates, life expectancy, healthcare inflation, and promises made to generations of workers who are, quite reasonably, expecting to be paid back. Now overlay the labor question, because a government, like any large enterprise, runs on people, millions of them. Civilian federal employees, uniformed military personnel, postal workers, and an enormous sprawling apparatus of contractors who do work the government has decided not to perform directly. Payroll and benefits for this workforce is not just a large number, it's a number wrapped in legal protections, union agreements, and pension commitments that stretch decades into the future. You cannot simply restructure a federal agency the way a startup restructures its org chart after a rough quarter. Every position, every benefit, every promised pension is layered with statute, precedent, and political consequence. Labor here isn't a cost center you optimize. It's closer to a permanent structural feature of the building itself. And this is where the rent question comes in, though in this analogy, the rent isn't a monthly lease payment. It's the physical footprint of the enterprise itself, the military bases scattered across the globe, the federal buildings in every state, the national park system, the aging infrastructure of dams, bridges, and highways that were mostly built 2 generations ago and are now quietly falling apart. Infrastructure engineers have estimated the investment gap needed just to bring existing infrastructure up to a state of good repair runs into the trillions. That's not new spending on new things. That's the cost of simply maintaining what was already built. The invisible bill that comes due, whether or not anyone chooses to pay it. Defer it, and the cost doesn't disappear. It compounds, the way a leaking roof left unrepaired eventually takes out the ceiling, the walls, and the foundation beneath it. Then there's competition, and this is where the metaphor of ownership gets genuinely uncomfortable. Because a country doesn't compete in a market the way a business does. It competes across generations against demographic math that doesn't care about political will. When Social Security was designed, there were roughly 40 workers paying in for every retiree drawing benefits. Today, that ratio has collapsed to something closer to 3 workers for every retiree, and it keeps shrinking as birth rates fall and life expectancy holds steady or rises. This is the quiet crisis sitting underneath the headline debt numbers. It's not a spending problem in the traditional sense. It's an arithmetic problem baked into biology and time, and it means the trust funds backing these programs are on a clearly projected path toward depletion within the next decade, unless something changes. Either revenue goes up, benefits go down, or the deficit absorbs the difference the way it's absorbed nearly everything else for the last 20 years. Now factor in cash flow pressure, because even a business this large is not immune to the mechanics of liquidity. Every few months, the federal government bumps up against its statutory borrowing limit, the debt ceiling, and Congress has to vote to raise it, or risk something no functioning business ever wants, a default on its obligations. Imagine running a company where, every year or two, your entire executive team has to publicly negotiate, sometimes down to the final days, whether or not they're allowed to pay the bills they've already committed to paying. It's a self-imposed cash flow crisis, manufactured entirely by political process rather than by genuine insolvency, and yet it rattles bond markets and credit rating agencies every single time it happens. In 2023 and again in prior years, rating agencies stripped the United States of its top-tier credit rating, specifically citing this recurring brinkmanship, along with the widening structural gap between revenue and spending. Picture a business whose own leadership occasionally threatens not to pay its own debts as a negotiating tactic. That's not a footnote. That's a genuine risk factor, disclosed the same way any company would have to disclose a material risk to its investors. And that brings us to the deepest risk of all, the one that doesn't show up on any single year's budget, but sits underneath every projection like a slow-moving tide. Compounding interest on compounding debt. Right now, interest expense is already exceeding $1 trillion a year and climbing. Left on its current trajectory, government forecasters themselves project that within a decade, interest payments alone could consume close to a fifth of all federal revenue. Money that produces nothing, builds nothing, protects nothing, existing solely to service debt accumulated from decades of spending more than was collected. In the private world, we'd call this a business trapped in a debt spiral, one where an ever larger share of revenue goes toward simply keeping the lights on for past obligations rather than investing in future growth. The only reason this business hasn't faced a true reckoning is that global investors have so far kept buying its debt, confident that the world's largest economy and reserve currency issuer will always find a way to pay. That confidence is an asset. It's arguably the most valuable asset on the entire balance sheet. And like any asset built on confidence rather than hard collateral, its value depends entirely on nobody testing it too hard. So here's what ownership of America actually looks like once you strip away the ribbon cuttings and the anthems. You inherit a revenue stream that's genuinely enormous, the largest of any enterprise on the planet. But you also inherit expenses that are almost entirely locked in before you arrive. An aging workforce commitment measured in the tens of millions of beneficiaries, an infrastructure bill quietly accumulating in the background, a demographic clock working against your two largest programs, a debt load exceeding the entire yearly output of the economy underneath it, and an interest bill growing faster than almost any other line item in the budget. You own something that looks, from a distance, like the most powerful business ever built. Up close, it looks like a company that's been running an unbroken multi-decade deficit, financed almost entirely by the world's continued willingness to lend, propped up by an asset that isn't a factory or a patent, but simply trust. That's the real economics of running America. Not a fantasy of unlimited power, but a high-wire act performed over trillions of dollars of obligations, sustained for now by confidence rather than by balance. And confidence, as anyone who has ever watched a business collapse can tell you, is the one asset that never shows up on the books, right up until the day it's gone.